The health inspector didn't just write up the Plano headquartered giant. He recorded black biological growth inside the dough preparation stations, right on the food contact surfaces. That dough was tossed, topped, baked, and served to paying families that exact same afternoon. Welcome to the modern American pizza industry, where corporate spreadsheets have quietly replaced food safety standards, and your favorite Friday night tradition is being dismantled piecemeal to protect private equity margins. Across the United States, thousands of iconic red roofs are going dark. Pizza Hut is aggressively closing massive amounts of locations, shuttering long-standing community hubs overnight. But while corporate communications preach market optimization and shifting consumer habits, the underlying truth is far colder. When state authorities raised minimum wages to protect workers, major operators didn't look for operational efficiencies. They fired thousands of in-house delivery drivers overnight, dumping the human cost onto third-party gig algorithms, while their parent company posted over $6 billion in revenue. This isn't an isolated story of a struggling franchise. It is a systemic, multi-billion-dollar extraction strategy. Over the last decade, private equity firms have systematically bought up America's classic pizza chains, stripped their real estate, loaded their balances with insurmountable debt, and sold the physical buildings right out from under the kitchens. They slashed labor to skeleton crews, compromised ingredient integrity, and left the remaining franchise operators running on margins so paper-thin that basic sanitation has become a financial luxury. Right now, a silent war is being fought between Wall Street extraction models and public health. When you open a pizza box in 2026, you aren't just buying dinner, you are participating in a massive financial experiment where safety protocols are weighed directly against corporate exit multiples. What happens when a business model forces a store manager to choose between paying for crucial refrigeration maintenance or meeting corporate royalty demands? You end up with raw dough sitting 13 degrees above safe refrigeration thresholds, rodent droppings feet away from flour bins, and surge pricing algorithms testing just how much you will pay for a cold delivery. The rules of the fast casual game haven't just changed, the entire board has been flipped, and the consumer is left swallowing the risk. The structural decay of the American pizza industry did not occur overnight. It is the result of 4 decades of aggressive corporate consolidation, financial engineering, and geographic traps. To understand how black mold on prep tables and mass driver layoffs became standard operating procedure, one must trace the shift from founder-led restaurant chains to financialized holding structures. In the late 1970s and throughout the 1980s, pizza chains were expanding rapidly across suburban highway corridors. The business model relied on owned real estate, long-term labor, and simple supply chains. Herman Cain saved Godfather's Pizza from bankruptcy in 1986 by executing a classic leveraged buyout with his executive team, briefly demonstrating that operational control could revive a regional giant. However, by the 1990s, public holding conglomerates and private equity entities recognized that restaurant brands possessed 3 highly monetizable assets: national brand recognition, predictable franchise fee streams, and valuable commercial real estate. The corporate playbook shifted dramatically when major conglomerates began unbundling these assets. Yum! Brands, spun off from PepsiCo in 1997 as Tricon Global Restaurants, took control of Pizza Hut, KFC, and Taco Bell. Instead of focusing on store-level operations, corporate headquarters in Plano, Texas, prioritized a fee-for-service model. Corporate collected fixed percentage royalties on top-line gross sales, regardless of whether an individual franchisee was profitable. This created a fundamental conflict of interest. Corporate thrived on volume, while local operators absorbed rising labor, food, and utility costs. Simultaneously, private equity firms descended on middle-market chains. When Lee Equity Partners acquired Papa Murphy's in 2010, before passing it off to MTY Food Group in 2019, the financial strategy was not focused on dough quality or kitchen sanitation. The focus was financial extraction. Private equity firms frequently utilized sale-leaseback transactions. Under this mechanism, the firm buys a restaurant chain, sells the underlying real estate to institutional real estate investment trusts, REITs, and forces the individual restaurant locations to sign long-term, triple-net leases. The immediate cash injection from real estate sales flowed directly to the private equity owners as dividend recapitalizations. Meanwhile, the local franchise operators were left burdened with high monthly rent obligations on buildings they previously owned outright. When economic pressures mounted, these franchisees could not renegotiate their leases. The real estate trap locked them into fixed overhead, forcing them to cut costs where corporate could not easily monitor them. In-store staffing, maintenance of refrigeration units, and daily deep cleaning routines. The geographic trap further compounded these financial strains. Brands like Sbarro built their entire footprint inside suburban shopping malls and highway rest stops during the retail boom of the 1980s and 1990s. As foot traffic in American malls collapsed over the past 2 decades, Sbarro found itself trapped in non-viable real estate with long-term lease commitments. The company filed for Chapter 11 bankruptcy protection twice, first in April 2011, reporting $294 million in debt, and again in March 2014. Rather than exiting dying retail environments entirely, post-bankruptcy restructuring funneled Sbarro into captive venue spaces, such as airports and tollway service plazas, where consumers have zero alternative choices and pricing power remains absolute. The labor dynamic underwent a parallel collapse. For decades, in-house delivery drivers were the backbone of major chains, serving as a primary point of customer contact and assisting with kitchen sanitation during low-volume hours. The inflection point occurred in April 2024, when California implemented Assembly Bill 1228, establishing a $20 per hour minimum wage for fast food workers. Major Pizza Hut franchisees, including Pack Pizza and Southern California Pizza Company, responded by terminating over 1,200 in-house delivery drivers across the state. Instead of absorbing wage increases or adjusting corporate royalty takes, franchisees outsourced delivery entirely to third-party aggregator platforms like DoorDash and Uber Eats. This decision eliminated payroll tax obligations, workers' compensation exposure, and vehicle liability insurance for operators. However, it transferred the physical delivery process to gig workers who operate outside store-level health compliance protocols, while simultaneously adding platform commissions that squeezed customer value and degraded food temperature control. By 2026, the historical transformation was complete. The shift from real estate ownership to sale-leaseback liabilities, combined with the transition from stable employment to gig economy outsourcing, left the physical infrastructure of the pizza industry deeply vulnerable. The financial engineering designed to guarantee quarterly returns for parent corporations successfully insulated Wall Street from operational risks, while systematically starving the restaurant kitchens of the capital required to maintain basic food safety standards. The financial engineering of the past 2 decades has culminated in a direct, measurable crisis inside restaurant kitchens across North America. Across urban markets and suburban strip malls, the operational realities of major pizza brands reflect a structural breakdown where cost-cutting strategies directly conflict with basic public health standards. In Plano, Texas, Yum! Brands executed a sweeping strategic review of Pizza Hut, declaring plans to shutter 250 underperforming locations across the United States. Simultaneously, EYM Pizza, one of Pizza Hut's largest franchise operators, declared bankruptcy after defaulting on millions in loan obligations, leading to the liquidation and forced sale of over 120 locations across Texas, Wisconsin, and Indiana. Court filings from the bankruptcy proceedings revealed a system locked in litigious combat. Franchisees accused corporate management of failing to modernize digital infrastructure and imposing unviable cost structures, while corporate cited operator failure to maintain store standards. Fast Company. As financial disputes escalate, store-level sanitation metrics show severe degradation. Municipal health inspection records from 2024 through 2026 expose systemic operational failures. In Tennessee, municipal health reports cited a Pizza Hut location holding cooked pizzas at 112 degrees Fahrenheit prior to customer dispatch, well below the federally mandated 135-degree safety threshold required to prevent bacterial proliferation. In New York State, Health Department inspection filings logged recurring critical violations, including failure to maintain cold hold refrigeration for potentially hazardous toppings and persistent non-food contact surface contamination. The conditions inside competing chains reveal identical pressure points. Godfather's Pizza, operating under an aging network of thin-margin franchisees, accumulated severe health code citations across Midwestern locations. Inspection reports filed in Kansas documented rodent droppings situated within 6 feet of active dry flour storage bins, the core raw material used for daily dough production. At Papa John's franchise units in Georgia, state agricultural and health inspectors cited facilities for storing raw chicken wings directly above ready-to-eat pizza toppings inside walk-in coolers, creating immediate cross-contamination hazards. The take-and-bake model pioneered by Papa Murphy's demonstrates how operational starvation impacts concepts built entirely on raw ingredient handling. Following its acquisition by MTY Food Group, franchisee associations issued public statements detailing unviable financial conditions caused by escalating corporate fee extractions paired with rising raw ingredient costs. The operational stress manifested in health records. An inspection of an Oregon location documented raw dough products stored at 54 degrees Fahrenheit, 13 degrees above the legal 41-degree refrigeration ceiling, forcing the immediate destruction of inventory. Multi-state public health investigations by the Centers for Disease Control and Prevention and state health departments previously linked raw dough products from Papa Murphy's to salmonella outbreaks across multiple states, requiring emergency public health advisories and product recalls. Food safety news. Simultaneously, major operators have turned to algorithmic revenue extraction to offset declining foot traffic and rising overhead. Domino's, which generates over $4 billion in annual domestic system revenue, initiated tests of dynamic pricing mechanisms integrated directly into its proprietary mobile ordering application. Utilizing user location data, order frequency, and hyperlocal demand metrics, the system calculates fluctuating price points for individual users. This dynamic pricing framework, mirrored after airline ticket management and rideshare algorithms, treats consumers as variable yield targets rather than static retail buyers. While corporate entities implement algorithmic pricing, frontline staff operate under severe resource constraints. Former employees and delivery drivers across major national chains have documented shifts where single prep tables remained unsanitized through 8-hour high-volume production cycles due to minimal staffing models enforced by corporate labor algorithms. The elimination of dedicated store drivers in favor of third-party delivery contractors has further severed the chain of custody for food safety, leaving orders sitting unmonitored under degraded thermal lamps for extended durations. The current state of the industry presents a complete deadlock. Parent corporations continue to collect fixed royalty streams and transaction fees, insulating themselves from store-level inflation and operational liabilities. Franchise operators, locked into rigid real estate leases and rising supply chain overhead, cut labor and maintenance to maintain basic solvency. Consumers pay higher prices for a product prepared in kitchens operating on skeleton crews, where basic sanitation protocols are routinely compromised to keep up with digital order volumes. The financial mechanisms designed to maximize short-term shareholder extraction have brought the physical infrastructure of national pizza